Spanish Prime Minister Mariano Rajoy can breathe a sigh of relief today after election victory in his home region of Galicia. Hopes that this has cleared an obstacle to Madrid seeking international aid have helped support European stocks and the euro. I'm joined now by ICAP Head of Interest Rate Strategy, Phil Tyson. Phil, encouraging election result, as I said there, for Mr Rajoy, and dare I say it, it's eerily calm on the Eurozone front.
Yeah, I think there's a little bit of relief this morning. I think, to be honest, it's a vote of confidence for Rajoy in that he can pursue austerity, tax hikes, spending cuts, and still retain a majority. In fact, increase his majority in his home region. I think the big question for markets now is that, will they go ahead and ask for some sort of bailout, or will it be delayed yet again? I think the fact that we've got another sort of regional election coming through at the end of November on the 25th in Catalonia, which potentially means there could be more sort of nationalistic calls there, separatist calls. That means it could be delayed again, potentially beyond the end of November, before we see a bailout. At the moment, the markets are giving the Spanish authorities the benefit of the doubt. They've had these elections. That means that it's prevented them from asking for some sort of bailout. But once they run out of excuses, I think that's when we could start seeing upward pressure on Spanish bond yields.
Let's face it, though, the referendum in Catalonia is much bigger than the vote that we had this weekend, and if, as you say, it pushes it back into December, realistically we're looking at next year.
Exactly, yes, but I think before next year they're going to have to do something, because funding needs are going to pick up substantially next year as the new fiscal year sort of gets underway. I think net funding in Spain is going to be potentially between sort of 50 billion euros. And let's not forget that Spanish bond yields are full on the expectation that they are going to ask for a bailout, once these elections are potentially out of the way. And if that doesn't happen, then we could start seeing yields rise potentially in the run-up to next year, as given this increase in funding pressures. So it's almost as if the markets will potentially have to force the Spanish authorities to the negotiating table, so we could see these Eurozone stresses rise again. So
Rajoy is still stalling, as we know, on seeking that international bailout. We had the summit last week. Still things being kicked into the long grass, particularly about banking union. If this was 3 months ago, yields would be spiking higher. Yet, as I said, we seem to be in a period of eerie calm.
Yeah, exactly. As you say, I mean, the whole banking union thing looks like it's going to take at least a full year or so, that's being speculated about, to sort out. So that's being pushed further back. We're seeing some sort of compromise potentially being reached on Greece, so the hard decisions maybe are delayed until after the German election next year. So things are getting pushed back. But as I say, at the moment, markets are giving the European authorities the benefit of the doubt. We've seen some pressure on core European bond yields. They've been pushed somewhat higher. We might see that trend continue in the short run, but I think we're reaching the limit of that, because ultimately, we're seeing the data coming out in Europe, which is still very disappointing, especially in the peripheral markets, but also now in the core. The German economy is showing signs of slowing down, so that's going to keep a lid on the rise in core bond yields, I feel.
Okay, you sorry to interrupt, but you mentioned Greece. I'm just wondering, is it too premature to say Greece may be turning a corner? We had data today that showed it posted a current account surplus for the second straight month. Is that too early to call?
I think it is, too early to call, because potentially what we've seen is a deterioration in the growth dynamics in Greece, and the debt dynamics as well. I mean, even though we had a more austerity sort of going through, I think the deterioration in the growth outlook over the course of this year so far means that is still not going to be enough. That potentially means more austerity is going to be required further down the line. That's going to increase the tensions within the governing coalition there, potentially increase political uncertainty, putting upward pressure on bond yields again if we do see some sort of breakup in the coalition. I think Greece is far from out of the woods, and I think some sort of exit at some point next year is looking inevitable at this stage.
Okay, just to finish up very quickly, if you can, what are the big hurdles? What are the main hurdles that the Eurozone faces this week?
It's fairly quiet in terms of data. We've got the IFO survey in Germany, some of the PMI forward-looking surveys in the rest of Europe, which should be increased slightly, but they're still at a very low level. It should emphasise the sort of recessionary environment that we've been talking about in the Eurozone. There's not much expected out of the FOMC in the States this month. I think the big decisions are going to be taken in December. Really, I suppose we're left with the growth numbers in both the US and the UK, the GDP numbers, which I think on balance are still going to be relatively lacklustre.
OK, Phil, thank you very much. That's it for now. My thanks there to Phil Tyson of ICAP. Coming up, find out what Tuesday holds in store. Europe Day Ahead will be available from 4:30 London time. I'm Jamie McGeever. This is Reuters.